So let us begin with question number 27. Let us read this question first. NJ Limited is planning to start up a project with an initial outlay of rupees 1 crore 25 lakhs. The project has life of 10 years and the residual value of assets at end of its life is expected to be rupees 10 lakhs. The depreciation rate as per tax law is 20% per annum on WDV basis. Tax rate is 40%. The company targets minimum rate of return of 10% per annum. The following profit before depreciation and tax, that is PBDT, are expected to arise from the project. They have given for year 1 and 2 rupees 10 lakhs per annum. For 3 and 4 it is 20 lakhs per annum. For year 5 to 7 it is 30 lakhs per annum, and for years 8 to 10 it will be 40 lakhs per annum. What is further informed in the question? Let us see. You are required to advise NJ Limited whether it should start up this project based on the following assumptions. Number 1, NJ Limited is an existing and highly profitable company. Number 2, NJ Limited is a newly started company. Now friends, what will be the impact of these two assumptions? I will be explaining in detail when the right time comes. However, what we do right now is we observe what all is informed to you. Let me take you back to the early part of the question. Over here, if you can observe, the life of the project is 10 years, and for each of these 10 years, the cash flow before tax, that is the profit before depreciation and tax, have been reported. So we can list out all these profit before depreciation and tax amounts. Against this, we will be charging depreciation on the project assets, and that will be at the rate of 20% per annum on WDV basis. And from PBDT, when you subtract depreciation, you will arrive at profit before tax, and then those profit before tax will be subject to tax. Tax rate is given as 40%. Once you arrive at profit after tax, then adding back the amount of depreciation, you will get annual cash flows after tax. Now that is a very basic fundamental thing. What is something special about this particular question? I will just convey to you in a short while. So what I want you all to do, when you are putting up the solution of this question, just draw a table, and on top of that you first begin with this first assumption that NJ Limited is an existing and highly profitable company, and we are now putting the heading as calculation of ACF, that is annual cash flows, and present value of annual cash flows. So quickly write up this heading, and then I show you the kind of table that you need to draw over here. Alright friends, after writing this heading, what I want you all to do is just draw this table. Can you notice one thing, that even on the screen the table is not fully on display? What I really want you to understand is after these all columns there will be couple of more columns. So when you are drawing the table, make sure that the space is arranged properly so that there is no problems ahead. So there will be one more column after annual cash flow, there will be one more column for present value factors, and then there will be one more column for present value of annual cash flows. So just start plotting the values that we have. For all the 10 years of project life, you will first plot the amount of profit before depreciation and tax, which is clearly reported to you. Then you will compute and write up the depreciation amounts on WDV basis. And you should not forget to take the total of the depreciation, because at end of project life, when you are scrapping your project assets, the realizable value has to be matched with the WDV, so that we can come to know if there is any kind of capital gain or loss arising on such disposal of assets. Now we compute PBT, that is profit before tax, which will be profit before depreciation and tax minus the amount of depreciation. Can you notice friends, this 10 lakh minus 25 lakhs will give you a negative profit before tax that is amounting to 15 lakhs. Similarly, in the second year also there will be a negative PBT. Now the question arises, what should we do with these negative amounts of profits, which indicates basically loss? Here comes the role of that particular assumption. So then third year onward we have positive amounts of profit before tax. So let me explain you what will happen when you are dealing with a component of loss over here. Now please, before you write up, I want everyone's attention over here. Something very, very important. When there is a loss arising in your project, what does tax law talk about? Losses arising from your business. If there are losses arising from your business, from one source or from one business or from one project, if there is a loss arising, if it is an existing company and it has other business segments or other projects where those other projects are yielding profits, then loss of one project can be set off against the profit of other projects. This set off will reduce your tax liability, means there will be tax saving that will arise on account of your losses. So let me tell you one thing. This first year we have a loss of 15 lakhs. We have a loss of 15 lakhs. Just imagine all other projects taken together. If there is a profit of 1 crore, without this particular project you would have paid tax at the rate of 40% on 1 crore. But because of this project, what will now happen? You have a loss of 15 lakhs. Against 1 crore of profit you set off your loss of 15 lakhs, and now your taxable profit will be only 85 lakhs. In simple words, you will now pay tax at 40% on 85 lakhs. Otherwise you would have paid tax at 40% on 1 crore. So how much tax did you save? You have literally saved tax at the rate of 40% on an amount of profit of 15 lakhs. Therefore, that tax saving will be considered as a negative tax. Understand one thing very well. Tax is basically an outflow, but when there is tax saving, there will be an inflow, as good as an inflow, because that much tax you are saving. So when in the tax column you write a negative amount, you will be indicating that it is not an outflow towards tax, but it is a saving of tax. And how to present the calculations ahead, let me guide you over here, and with this explanation you may further continue to write. So the next column is very, very important column, and here we are able to save tax because the assumption that we have taken is that NJ Limited is an existing and highly profitable company. Because it is clearly known that it is an existing and highly profitable company, definitely the set off of losses is possible. So in the very first year you will be saving tax at the rate of 40% on this loss. So amount of tax saved, we have written 6 lakhs as a negative amount in tax column. Tax column indicates an outflow. When within tax column you are showing a negative value, means it is not an outflow, it is reverse of outflow, means it is basically saving of tax. Same thing will happen in the second year, and thereafter from third year what you have is all profit figures, and on those profits you are simply going to pay tax. Now notice one thing, because we have already offset these 2 years losses, there is no loss being carried forward. So from third year you will simply start paying taxes at the rate of 40% on the amount of profit before tax. Thereafter what you will do is, from profit before tax, when you subtract the amount of tax, you will arrive at profit after tax. Carefully notice one thing when you are dealing with the amounts of losses. So profit before tax over here is minus 15 lakhs. From this you have to subtract the amount of tax. So it is minus 15 lakhs minus of minus 6 lakhs will actually make it minus 15 lakhs plus 6 lakhs, which will result into profit after tax of minus 9 lakhs. Logically, if we talk, from 15 lakhs of loss, if you have made a tax saving of 6 lakhs, your profit after tax will be only negative 9 lakhs. In other words, your loss reduces from 15 lakhs to 9 lakhs because 6 lakhs is the amount of tax that you have saved on account of this project. Similarly, second year, the profit after tax is a negative amount of 6 lakhs. Thereafter, from third year, profit after tax will be simply profit before tax minus tax. You can list out all the components of profit after tax. Thereafter, what you can do is adding back the amount of depreciation, that is these depreciations when you add back to profit after tax, you know what you will get is the amount of annual cash flows. So what we do is we first write up this whole component. Don't forget, in your table 2 more columns are yet to come. I am waiting for you to first finish writing this whole thing, and then I'll show you those additional 2 columns, and that is the time when you should also write down those 2 additional columns. I'm giving you time. First take note of this whole thing. Alright friends, so I'm sure you would have finished writing this much. Let us move ahead and write up the next 2 columns. There will be PV factors at 10% per annum and PV of annual cash flows. This I don't have to explain to you. You know how to get the PV factors and how to convert the annual cash flows into their respective present values. And needless to say, you are going to take the total of PV of annual cash flows. That will be total PV of annual cash flows. Please write up these last two columns as well, and then I take you ahead. Alright friends, if you have finished writing this much, let us move ahead and deal with the next working, that will be calculation of terminal cash flows. Now please carefully understand this working. This is something very important. Sale value of assets at the end of project life is going to be rupees 10 lakhs. This is the estimated sale value of assets. But what will be the WDV of assets at end of life? Here what we do is, the cost of the project assets was 1 crore 25 lakhs and the total amount of depreciation for 10 years of life on WDV basis, we have taken this total as total of depreciation of 10 years. That means initial cost of project assets minus the total accumulated depreciation, the WDV of assets at end of life will be 13,42,178. Now if this is the sale value and this is the WDV, definitely you are selling the assets at less than its WDV. So the result will be a capital loss. You should know one thing very well. Under income tax laws, any kind of depreciable asset will always result into short-term capital loss. So don't ever enter into mess that the assets are 10 years older, so it will be long-term capital loss. These are depreciable assets. Depreciable assets will always have short-term capital gain or short-term capital loss. Now if there is a short-term capital loss, because of this loss you will again have tax savings. So tax savings on short-term capital loss will be 40% of the amount of the loss. So the amount of tax that you save on termination of assets, it is 1,36,871. This amount of tax savings plus this amount of sale value, both taken together, will be the total cash flow on termination, and aggregate of these two is coming to 11,36,871. So please write up this working and then I take you ahead. Alright friends, once you have finished writing this much, now let us do the easy part, that is computing NPV. The total PV of annual cash flows we have worked out on that big table last point, and the terminal cash flow what we got 11,36,871, it is arising at end of 10th year. So what we have done is we have taken the PV factor for 10th year, that multiplied on terminal cash flow, this will give you the present value of terminal cash flow. This is present value of annual cash flows, this is the present value of terminal cash flow. The aggregate of this will give you total PV of inflows, and from that you subtract total PV of outflows, which was 1 crore 25 lakhs, and the resulting outcome is the net present value. So please write up this whole thing, and that will be end of the first part of your solution. Alright friends, so that was the first assumption that we have dealt with. Let us now write the next line of assumption, that will be NJ Limited is a newly started company. We will still compute the same thing, that is annual cash flows and PV of annual cash flows, but this will be under the new heading, that is NJ Limited is a newly started company. So what will happen in this scenario, I'll explain you in detail, but first you quickly write this heading. Once you finish writing this heading, let us move ahead and make up that table. So same style of table, don't forget that at the end you have to include two more columns, that is PV factors and PV of annual cash flows. Because of limitation of the screen size, I am not displaying the whole table in one go. I'll give you time to note it down. So what I want you to do is, from year 1 to 10, the amount of profit before depreciation and tax is reported in the question. Thereafter, depreciation you will work out on WDV basis, and you will not forget to take the total of depreciation column. Thereafter, you work out the amount of profit before tax. Now, what is to be done ahead? Let me explain this to you. When it is a newly started company, that means this particular project is going to be the first new project of this newly started company. Now, if there is a loss arising from this project, there is no possibility of setting off that loss with any other source of income, because the company is a newly started company. So the only possibility that is permissible by tax law is to carry forward this loss, and what we do is we carry forward this loss and set it off against the future taxable income from the same project. So we have seen that in the year 1 there is a loss, in year 2 there is a loss. So what will be the amount of tax that you pay? It will be 0 and 0. So no tax payment, no tax savings. There will be tax savings, but not in year 1 and year 2, but it will be arising in later years when your outflow towards tax is getting reduced because of set off of the carried forward losses. So what is happening? any kind of loss that is arising in your business, it will be eligible to be set off. If it is an existing and highly profitable company, the set off will happen in the same year in which the loss arises. If it is a newly started company like this, what will happen? You will have a loss now. It will not be set off immediately because you don't have other income against which this loss can be set off. This loss will therefore be carried forward, and only after a carry forward, when at later years when you start earning profit, against those profit the brought forward losses will be offset, and only when you have the final positive balance of your profits which will be taxable, then onward you start paying tax. So when you are drafting the tax column, you have to be extremely alert, and I'll guide you how to do that. So just carefully pay attention to this whole thing. So when you are talking about the tax of first year, as I told you, the amount of tax that you will pay in first year will be nil. Amount of tax that you will pay in the second year will also be nil. Now notice one thing, how much amount of loss that you have already carried forward on cumulative basis. 15 lakhs of loss of first year, 10 lakhs of loss of second year. So the amount of loss that you have carried forward is 25 lakhs. You can find that the loss that can be set off in the third year is 4 lakhs. So what will be the taxable profit after set off of that loss? The taxable profit will still be 0, and therefore the tax amount will still be nil. Now out of 25 lakhs of loss, 4 lakhs got set off. Now the remaining loss is 21 lakhs. That will be carried forward in the fourth year, and now in the fourth year the set off that will happen will be 7,20,000. That 7,20,000 of set off, once you have, the brought forward loss is more than the amount of taxable profit, so there will be again no tax in the fourth year. So fourth year tax will again be nil. Then amount of loss that you still have remaining, let us compute, pick your calculators. 25 lakhs was the total amount of loss, minus 4 lakhs of set off in the first year, minus 7,20,000 of set off in the second year. I mean first year from the date of loss and second year from the date of loss. Precisely I would say third year and fourth year. So once again let me repeat, 2 years you had loss of 25 lakhs, third year there was a set off by 4 lakhs, fourth year there was a set off by 7,20,000. After 4 years, the remaining amount of loss that you still carry forward is 13,80,000, but in the fifth year there is taxable profit of 19,76,000. So your entire remaining loss will get set off, and now the profit that will be subject to tax will be difference between 19,76,000 and 13,80,000. That comes to 5,96,000, and that 5,96,000 will be taxable at the rate of 40%. So amount of tax that will come over here will be 40% of 5,96,000. That will be 2,38,400, and thereafter from 6th year onward tax will be simply 40% of the amount of profit before tax, and from PBT when you subtract tax you will be getting profit after tax. To the amounts of profit after tax, when you add back depreciation, you will be getting annual cash flows. Please write up this whole thing, keeping in mind that you have 2 more columns to present at the end of the table. But first you finish writing this, and then I'll show you those 2 additional columns. Alright friends, so once you have finished writing this much, we can put up the last two columns now. Those last two columns will be PV factors and PV of annual cash flows. I don't have to explain you any of these. You know how to do this part. And once you write up the PV of annual cash flows, take that total, that will be the total PV of annual cash flows. So write up this whole thing, that is the last two columns, and then I take you ahead. Alright friends, I am sure you have finished writing this whole thing. Let us move ahead and make up the next working, that is calculation of terminal cash flow. You would find that this whole working will be exactly the same that we did earlier. Mind it, this company was a newly started company at the beginning, but by end of 10 years, this will be an existing and highly profitable company by default, and the cash flow arising on termination will be exactly same as you have found in the first assumption. So if you don't want to repeat writing this whole working, you may just write up quickly one thing, that terminal cash flow will be 11,36,871, and you can write within brackets same as in assumption 1. And friends, once you are done with this, let us write up the last part of our calculation, that is the calculation of net present value. It will be same thing, only the figures will be little different. So this time The total PV of inflow is coming to 1,22,99,954, and when you subtract the total PV of outflows, what you get is net present value of 200,046, that is 2,46,000 negative. So please write up this last part, and that will be end of the solution.